What is the difference between a negative PE ratio and a really high PE ratio? By the way, PE ratio is just a company's share price divided by its earnings per share. A negative PE ratio means the company reported net losses over the measured period of time. In other words, the company is unprofitable. That doesn't sound great. Why would you want to invest in an unprofitable company? But there are, of course, a few caveats to that negative PE ratio. For example, maybe they heavily invested in growth, or it's a cyclical industry, or they had a temporary setback. Not only that, but they can have positive earnings per share for 3 quarters. If they have negative earnings per share for just 1 quarter, that will make their EPS negative for the whole year. The other caveat is that the larger the negative number, the closer the company is to profitability. So that can be a little confusing. So a company with a PE ratio of negative 0.1 is more profitable than a company with a PE ratio of negative 100. Now, if a company has consistent earnings per share that's negative quarter after quarter, year after year, that's a sign that the company is not doing very well. They're financially struggling. Now let's talk about the really high PE ratio. Really high PE ratio means the company's share price is much higher in relation to how much they earn. That means investors are expecting significant earnings growth in the future, and they're willing to pay a premium now to get it. But there's always a but. If that future growth doesn't materialize, the stock price can go way down. That really high PE ratio could indicate that the stock is overvalued, especially if it does not measure up to those future earnings expectations. So a really high PE ratio can reflect investor optimism about future growth, but it can also be a warning sign of overvaluation and risk if those expectations are not met. This is good info, you guys. Like, follow, share, subscribe.